We'll be looking at Module 5 under Forex Trading, Risk Management, and Trading Psychology. In the Forex market, success is not determined solely by the ability to analyze charts or predict price movement. While technical and fundamental analysis provide valuable tools, they do not guarantee consistent profitability. By the end of this module, students should be able to define risk management and explain its importance in Forex trading, explain the concept of capital preservations and its role in long-term trading success. Calculate and apply risk to reward ratios in trading decisions. Determine appropriate position sizes based on account balance and risk tolerance. Explain the importance of portfolio diversification, reducing overall trading risk. Identify emotional factors that influence trading decisions, including fear and greed. Apply techniques for maintaining emotional control and discipline trading. Explain the psychological impact of both losses and gains on trader behavior. Analyze the consequences of poor risk management in real trading scenarios. Apply practical strategies used by professional traders to limit risk on each trade. Lastly, they should be able to develop a structured and disciplined approach to managing risk and maintaining consistency. By way of introduction, one of the most critical factors that determine long-term success in forex trading is the ability to manage risk effectively and maintain psychological discipline. Risk management refers to the process of controlling potential losses in trading. Every trade carries uncertainty and it is impossible to predict market movement with complete accuracy. Traders must focus not only on potential gains but also on how much they are willing to lose. Capital preservation is the foundation of risk management. The goal is not just to make profit but to protect trading capitals over time and remain in the market. Trading also requires strong psychological control. Markets movement trigger emotions such as fear, greed, frustrations, and overconfidence, which can influence decisions. Trading psychologist focuses on controlling emotional responses. A disciplined trader follows a structured plan and avoids emotional decision making. We're looking at our first term under this module, capital preservation. What is capital preservation? Protecting capital is more important than making profits. Capital is the initial fund used when trading. It's more important than making profits. Losses must be controlled to remain active in the market over time for stability. Beginner traders often focuses on profit and ignore the risk. It's true. Professional traders ask, how much am I willing to lose before entering a trade? Let's look at the risk to reward ratio. What is it or what it is? This compares the potential loss to the potential gain. Example, losing $50 to gain 150. This is in the ratio 1 to 3. The risk to reward ratio allows profitability with fewer winning trades. It helps to maintain discipline by setting stop loss and take profit levels. I already explained this in the previous module. However, profitability must also be considered. Let's look at position sizing. This determines how much capital to allocate per trade. The common rule is risk 1%, 2% of account per trade. That's the common rule. So when you are trading, risk only 1% or 2% of the money in your account per trade. An example, if you have $1,000 in your bank, use only 10% to 1%, which is $10 per trade. This ensures no single trade damages the account significantly. This is known as position sizing. Then we have portfolio diversification. The portfolio diversification is spreading risk across multiple trades to reduce your exposure to risk or losses. It avoids concentrating on your capital in one position. Let's look at psychological stability. Emotional control is essential. Fear and greed influence decisions and can lead to poor trading behavior. Fear causes early exit or hesitations, while greed leads to excessive risk taking. Frustration leads to revenge trading. So these are three psychological factors that can lead to losses in forex trading. Let's look at discipline. Discipline is following a structured plan consistently. Under discipline, you avoid impulsive decisions. You maintain consistency over time. Let's look at emotional control. Emotional control, this is when you manage emotions triggered by rapid price movement. If you are trading, prices can just change. Losses, how do you manage losses? It's part of emotional control. Missed opportunities and volatility, how prices fluctuate. Now let's look at a very key important term or an important term, traders' well-being. This is the mental and emotional states and how it affects your performance. Stress and pressure can negatively impact your decisions to be taken. Coping with losses. How do forex traders cope with losses? Losses are unavoidable in forex trading. Traders should have accept losses and focus on long-term performance. How should they cope with gains? Gains can create overconfidence on the part of the forex trader. So traders must be disciplined and avoid increasing risk unnecessarily when they are making gains. Now let's look at a real trading scenario. Let's look at a real life example. Let's say trader A, it takes 20% per trade. Let's say he has $1,000 in his account and it takes 20%. 20% is $200 and trades. If he loses that $200, he has lost 20% of his account. That's a great loss. So a loss reduces the account significantly to $800. Further losses will lead to emotional decisions. You want if he makes loss, you want to be like, okay, the next trade will be better. He will make loss again. The next trade will be better. He will make loss again. The next trade, it will keep on making loss. So the best thing to do, like I said, is the 1 to 2% rule. Don't use more than 1 to 2% of the funds in your account. Now, what are the lessons to learn from this scenario? Large losses are difficult to recover, very difficult. Proper risk management prevents account destruction. So if you don't manage your account properly, it will it will lead to losses and amongst other things, even account destruction. Now let's look at how to protect your capital. An example. Now a professional trader risk 1% per trade. They use the stop loss and they take profit signals. They maintain consistency and they protect their capital. Even with losses, the account remains stable. The focus is on long-term growth and stability, not short-term gains. This is how you know a professional forex trader. They take 1% per trade, they use stop loss and take profit, they maintain consistency, and they protect their capital. Even with losses, the account remains stable. The focus is on long-term growth, not short-term immediate profit. Now, by way of conclusion, this module has explored the essential principles of risk management and trading psychology in the forex market. It has emphasized that long-term success in trading depends not only on analysis, but also on the ability to control risk and maintain discipline. The module introduced key capital preservation strategies, including the risk to reward ratios, position sizing, and portfolio diversification. These strategies help traders limit potential losses and protect their trading capital. So this module covered all of that. What is risk management? How do you handle your risk? How do you handle psychology? Traders' well-being. Traders should prioritize this. What should traders do to prioritize their well-being? Should they do to ensure the long-term success? Should they look at short-term gains or look at stability? If you're looking at short-term gains, you continue making losses. But if you look at long-term growth and success and stability, you discover that you make wiser decisions. So that's all for this module. At the end of this module, there's an assessment session where there's 15 MCQs and a report to be written to better understand this module. I'll see you in the next module.